Welcome to Navigation Trading Live. You are now part of a growing group of do-it-yourself traders who are trying to change the way investors think about building wealth. But because we don't believe in using financial advisors, stock tips, or traditional financial media, we have to do things different. We have to do things smarter. We do that through an art and a science we call trade hacking. At Navigation Trading, our methodology is based on statistics and probabilities, not hype or emotion. Our core strategies have been used by market makers, hedge funds, and floor traders for many years. Now, we share these secrets with you. Whether your goal is to make an extra $1,000 per month or replace your current income, with our guidance, you can achieve financial success beyond your wildest dreams. So, let's get started. What's up, Navigation Traders? Monday morning, May 14th. Hope everybody had a great weekend. This is our live broadcast that we do every Monday morning before the markets open. And if you haven't connected with us already, make sure you do so on our social media, Facebook, YouTube, and Twitter. This is where we make all of our announcements on upcoming events and releases. We broadcast live from our Facebook page and YouTube channel, simultaneously, so make sure you connect with us there. And remember, this is all about you. So if you have any questions or topics that you want me to cover on the live broadcast, just shoot us an email or drop a comment here on Facebook or YouTube, and we will do our best to either get back to you by email or talk about it live here on the broadcast. Let's go ahead and jump over to the platform and see what's going on in the markets. If we look at the futures first, S&P stocks very strong over the last week or so, week and a half. Had a huge rally from this bottom here. I put this trend line on here, not because we use trend lines to trade from, but just to give a little perspective of where the price has kind of come up and tested. Looked like it was going to roll over again off that and then just push through and cranked higher. So looking for kind of sideways to higher markets here. Now, we do like to carry short delta in our portfolio because you don't ever know what the market's going to do. But my short-term directional assumption is sideways to a little bit higher in the near term. So that's just kind of what we're looking at here at Navigation Trading. If we look at the different markets, you can see stocks are up just a little bit this morning, about a 0.25%. Oil is pretty flat. And you can see with this rally in stocks what it has done to volatility. This is the VIX futures. You can see volatility has just been sucked out of the market, which for our short premium plays, that's been a good thing. We've been able to close out quite a few winners. But now we'd obviously love to see volatility pick back up and get back. I like to see volatility in that kind of that 16 to 20 range is when it's really good. You get some good solid premium to sell in a lot of the options, but we will just continue to play it as it is. One symbol I've been looking at is RUT. And you can see and this is one that I like to do calendar spreads on. Those big indices, SPX, RUT, NDX, sometimes it's not quite as liquid. But you can see applied volatility is starting to get fairly low here. The percentile's at 19. I'll probably wait till it gets under 10 before I would put on a calendar spread here. But just to give you an idea of some of the things that we're looking at. Bonds and notes continue their downhill slide. Wheat and corn and soybeans a little bit mixed. Wheat's down over 1%. Soybeans up a little bit. Corn down a little bit. And the euro making a little bit of a bounce from its lows here. So what I wanted to do, and we can even look at this before the markets open. It's about to open in 3 seconds. So one of the symbols that I was looking at, and a lot of, usually on this live broadcast, we like to do a trade of the week and walk through our thought process of why we put on the trade. In this case, I'm going to do something a little bit different. So we're looking at EEM, and I want to walk you through the process of potentially putting on a trade and tell you some reasons why you shouldn't put on the trade. Okay, so I want to use EEM as an example. So I was going over this morning. If we go to the trade tab, and so we've got options with 32 days or 67. It's not a horrible idea to go out to 67, collect some more credit. But again, as our kind of rule of thumb, we like to stay in that wheelhouse of 30 to 60 days. So let's just go to the options with 32 days to expiration. Going back to the charts real quick, you can see EEM has a IV percentile of 63, so it looks like a potential candidate to sell premium in. So if we go to the trade tab, go to the options with 32 days to expiration. We've got the 15 or the 21 delta. I would opt for the higher one, so the 21. So you can sell, and because it's such a low price symbol, I would go naked here. So I would choose a strangle in this case for this example. And then going over here about the same delta, 19 and 24, we could do the 19, so 45.5. And what you'll see here is you're only collecting 55 cents of credit. So if we take that over to the Analyze tab, and that translates into $55 of max profit per contract, that's just not enough. With these lower price symbols, you got to do one of two things. A, you can't really buy the wings because then you're going to get even less credit. So you've got to use naked options. But even using a naked strangle, we're just not getting enough credit to make it worth it. Okay? So then we can go back to the drawing board and say, okay, what if we squeeze it a little bit tighter? What if we get a little bit closer to the money? You can see the 29 delta would be the next one up. So let's go ahead and sell a strangle there. And same thing on the other side. We can move up to, let's move to the 31 delta because it's a little bit closer to 29. So that'd be the 46.5. So now we're getting 89 cents of credit. So that's a little bit more worth it. If we go to the Analyze tab here, click off of the first one here. And now you can see we're getting closer to a straddle. So if we go ahead and set our slices to break even, you can see you're getting about a 60% probability of success. Now, the other piece of this is, okay, if I were going to do something, I would probably do this. Still getting a 60% probability of success. We're collecting enough credit to make it worthwhile, $89 per contract. So based on the position sizing that we're using in our alerts portfolio, we'd probably kick this up to 4 or 5 contracts. That would give us a max profit of $445. So if we're managing at 50%, we could book a couple $100 at least on the trade. And then you look at if you hit confirm and send and check out, the problem is now you're using $4,200 in buying capital. Is it worth it? It's borderline. I would probably put this trade on. However, if I was just looking at it in a silo, however, knowing what I have in our portfolio already with some of the other ETFs and emerging markets, EWW, and some of the other things, and with implied volatility contracting the way it is, to me, I'm not going to put on a trade in this right here. And frankly, looking through everything else with implied volatility contracting like it is, and the way things are moving and the way we're set in our current portfolio, I'm not finding anything that really jumps out at me that says, yes, let's put this on this morning. And so I think this is an important topic because you don't always have to be putting on a new position. If you don't think it's really what you want and it really doesn't fit into your overall portfolio and you're not getting the best credit, it's okay to pass. And that's what we're going to do this morning. So not taking a trade can be just as important as taking a trade. And so I want to make sure that you understand how important that is. Again, this isn't a terrible trade. If it fit into your portfolio and you didn't have much on and you were looking to get some positions on, I would have no issue with you putting this trade, entering this trade. But in our case, I think I wanted to walk you through this process of of our methodology and just help you understand why it's okay not to take a trade sometimes. The other thing, if you wanted EEM in your portfolio, the other thing you could look at is you could go out to that 67-day cycle. Again, we like to stay in 30 to 60 just as a rule of thumb, but 7 days isn't a huge deal, and you're going to collect a lot more credit by going out to the 67-day cycle, and you've got some more strike selections to choose from, some more premium in those options, so that would be a potential trade candidate as well. For us, we are going to pass on this one, but we'll continue to monitor our current positions and hopefully look for some more trade opportunities the rest of this week. Everybody have a good week of trading. Talk to you soon.